Sorry in advance, my voice is still a little messed up from being sick, but let's not waste any time and jump right into the video. SoFi is a financial technology or fintech company that started out by making student loan products. They eventually branched out into making other types of loans and providing other financial services. Because of their branding and their roots, they resonate well with young people and have quickly grown their scale. SoFi essentially has three components to their business: lending, financial services, and technology. Lending would include all of their loan products and is currently the primary moneymaker. Financial services would be their bank accounts, credit cards, and investing platform. And finally, their technology section would be their recent acquisition of the company Galileo. There is so much to talk about just with Galileo, but we don't have time to get into depth in this video. The short version is that Galileo uses a bunch of superior technological tools to assist in online banking. One of the unique benefits that Galileo provides is superior fraud detection and prevention. I've pulled up SoFi's latest quarterly investor presentation, and as you can see here, we've got great growth in the number of new members, as well as the number of products and the number of accounts. On this next page, we can also see the increase in total lending products and financial services. So needless to say, SoFi is a growing company and all of the underlying products and services that they offer are healthy and growing. On this page here, you can see some annual performance data. Their adjusted net revenue is growing consistently, and they're also improving their adjusted EBITDA. If you look at the last 12 months, we actually have positive adjusted EBITDA for the first time. It's also good to see SoFi executing well. They had adjusted net revenue estimates between 245 and 255 million, and they came in at 277 million. Here you can see adjusted EBITDA and adjusted EBITDA margin values here, and actual numbers were better. So well done here with SoFi. Another interesting piece here is that for Q4, their guidance expects an acceleration in growth. And this is pretty remarkable for a fast-growing company, is to see an increase in the rate of growth. So I'll be curious to see what their Q4 numbers come in at once they report. Next up, we're going to look at the financial statements here on the latest quarterly filing from SoFi's investor relations page. I've got the balance sheet pulled up, and we're just going to take a look at a few things. And I also want to point out before we begin that analyzing the financials for banks is a bit of a different game than a lot of other products and services companies. Today, we're just taking a rough look to get us thinking in the right direction. If we look at the first three lines here of the balance sheet, we see SoFi's cash and cash equivalents coming in here at just under $1 billion, keeping in mind that all the numbers listed here are in thousands. We can also see this massive number here, this $4.8 billion are loans, right? SoFi is a bank, so they issue loans, and when other companies get a loan, we always think of this as debt, but in the case of SoFi, this is money owed to them, making it therefore an asset. Anyway, moving along, let's compare this $1 billion cash number to their accounts payable, operating lease liabilities, and their debt. We can see that they have a fairly considerable amount of debt. And without looking too much into the exact terms of their debt and when this debt is going to come mature, it's hard to know the exact picture, but we can roughly speaking say that they have quite a bit of debt relative to the amount of cash and cash equivalents that they have. The first thing that you're probably going to notice here is that this income statement looks completely different than most other income statements that you've probably seen. We've got interest income, interest expense, non-interest income, non-interest expense, and then we see total net revenue down here when we're used to seeing revenue up at the top. So it's kind of confusing what all is going on here. We're not going to go through all of the differences here, but let's start by just looking at their total net revenue. We can see that for Q3, it came in at $272 million, and for the 9 months ending September 30th, we've got just under $700 million. So we're probably going to see total revenue for this year just under $1 billion or thereabouts. Another highlight that we're going to need to look at is their net loss and comprehensive net loss. So we can see a net loss here of 30 million, the comprehensive loss around 30 million as well. There's very little difference here. And we can see that for the 9 months ending September 30th, we see a net loss of $373 million. So at the end of the year, we're probably going to be around $400 million in the hole on a net loss basis. Finally, we're looking at that statement of cash flows, and we see that negative net income number make its way down to this cash flow statement in the operating activities. Now we're going to reconcile all of the non-cash expenses throughout the year to see what the total change in cash was at the end of the year. The cash from operating expenses comes out to negative 113 million. If we scroll down to investing activities, we can see that that was positive 79 million. And finally, for financing activities, we can see this number was negative 434 million dollars. If we're to add up all these numbers, we get a final value of negative 469 million dollars. So SoFi is incredibly cash flow negative. And for those of you who watched my video on Dropbox, we saw a company that was break even or even a money loser on the net income line. However, they were very cash flow positive for reasons that I described in that video. But that is not the case here with SoFi. They have negative net income and are very cash flow negative as well. So a moment ago, I showed you the balance sheet was less than stellar, and now we know from the income statement that they run a massive net loss. Add to that the fact that the cash flow statement reveals they are cash flow negative. So let's connect the dots here. Either SoFi will be adding a bunch more debt or issue a bunch of new shares, which dilutes shareholder value. In reality, they'll probably be doing a combination of both. SoFi is currently trading for $11.8 billion. This puts it at approximately a 13 price to sales ratio. And it's trading this high even though the stock price is trading at the low end of its historical range. This is the tough part about investing in growth companies sometimes. You have to determine if the valuation premium you're paying is worth it given the growth prospects of the company. People online like to talk about how SoFi and Galileo form a moat. And I don't know if I completely agree with this. In researching for the video, it's clear to me that there is a synergistic relationship between SoFi and Galileo, and it does provide somewhat of a competitive advantage. But to me, it's a bit of a stretch to consider it a moat. The fintech space is incredibly competitive, and I don't know that SoFi is somehow impervious or impenetrable to other firms' competition. One of the reasons why SoFi's valuation is so high is because of its strong revenue growth. However, in my opinion, the biggest risk faced by SoFi is increasing interest rates. The Federal Reserve Chairman Jerome Powell came out saying recently that interest rates will be increasing in 2022. And this could spell bad news for a company like SoFi because when interest rates go up, demand for loan products goes down, which is their primary moneymaker and a strong driver of revenue. When this happens, revenue growth for SoFi might decrease. And because of a lot of the investors who choose SoFi are in it because of its revenue growth, if SoFi suddenly starts missing on revenue targets, these investors could then punish SoFi and its stock price. So here are some of my opinions. I like SoFi as a company, I really do, but I do need that stock price to come down a little bit further. Given some of the risks faced by the company, I'm not really going to be interested in picking up shares unless SoFi got below $12 a share, and if it got below 10, then I'd really become interested. Alternatively, if 2 years down the road, say, and the stock is holding up well, the company is doing well, it's navigated increasing interest rates, and overall the business model has remained intact, if at that point SoFi were trading around maybe $16 or $18 a share, I'd be paying more for the stock, but I'd be getting greater certainty. If that were the case, I would also be interested in picking up some SoFi. With that said, guys, if you've made it this far in the video, thank you so much for watching. Don't forget to like the video, comment down below, and consider subscribing. Until that next one, peace.